In today's lunch talk, we will talk about inflation and how we think about inflation. I'm very happy to have Michala Marcussen with me. And Michala, you are chief economist of a big European bank, of Société Générale. As such, you are in the heart of understanding how we think about inflation, what it actually does. So we are living through this, what many people now call a cost of living crisis. And many people are concerned about what happens to them. So how do we understand that suddenly inflation went up to levels we had not seen for a long time? And now it seems to be coming down, but we are not sure how far. So what happened?
So first of all, thank you very much, Rolf, for having me here today. And I think when we look at what happened in inflation, there was quite a conflux of factors playing in. If we just go back to early 2020, we went through an unprecedented shock with the pandemic. Suddenly, people across the world were forced to stay home and to stop spending. And this gave rise to a tremendous shock to the economy. Initially, the shock was very much focused on the supply side. There was a lot of disruption to production chains. We remember having all sorts of problems in procuring various goods. We heard a lot about disruptions to shipping routes. But then, of course, as the shock went on, other things started to play in. We saw when we started to get some reopenings that there was actually quite a strong demand at that moment. Why? Two things. First of all, people during the lockdown periods had actually saved up quite a lot of money just because we couldn't go out to spend. Secondly, we have to keep in mind that there was tremendous support from the government side coming through. And of course, as we moved through these various shocks, it was not just one wave of supply side shock followed by a demand side movement. We saw successive shocks from openings, closings, opening, closings. We remember these dynamics quite well.
And we saw the war.
And then, indeed, next shock comes. We saw the horrific war in Ukraine, where we saw a tremendous energy price shock coming through. And again, this time, of course, thankfully, there was no lockdown involved in that operation. But we again saw quite a tremendous response coming from the fiscal side in terms of support. And I think one of the really exceptional features we have to keep in mind about this cycle is that we also saw these super tight labor markets. So we also had a lot of report from companies. It's difficult to hire. Things are challenging. And when we look at this situation, remember also that there was exceptional government support to the companies, which meant that contrary to a normal recession, we actually saw the rate of bankruptcies fall because of this tremendous government support. So there's really been many, many things going on. And I think when we think about the current cost of living crisis, which is a very serious concern, we have to think about it in several ways. First of all, I think it's very important, and President Lagarde told us this, that it is important to help the lowest incomes deal with these shocks. But she told us very clearly that fiscal policy measures need to be targeted, tailored, and temporary. And I can only agree with her on this point. Then we have to think about a wage profit split. And initially, when we look at what's been going on in those dynamics, yes, the profit size of the equation has won. And I expect to see now we're going to get a rebalancing of this with wages doing a little bit more. A little bit of wage growth is good. But what we want to avoid is we want to avoid an excessive wage growth, which could then lead companies to make a significant adjustment to their employment and then see mass layoffs. This is what we want to avoid.
That is certainly what many people are concerned about, but a lot's going on.
That
is what I understand. Now let us try to dissect that a bit. So we talked about the war, and war per se is horrible, that we all agree. Now on the economic effect, right? So this is a driver of inflation because it kind of cut down on energy supply. So we all remember what happened with gas prices going through the roof. So then the natural point would be, well, that is what happened, we understand. And people said, yeah, that will feed into inflation and then it goes out. And some people said monetary policy doesn't need to react to it. And other people said it needs to react to it. So from that perspective, is it all then the war effect, and is it all the energy? That is what drove it basically, and now we are getting out of it, or maybe not.
So I think I really think there was many factors that played into the situation. But what I do think is when we look at the various aspects of the supply side and the demand side shocks, I think that the demand side shocks, much of the policy stimulus is now behind us. The fiscal policy stimulus is behind us. It's faded out. And in fact, as we look ahead to 2024, we probably have a moderate fiscal tightening coming through in Europe. Those excess savings, which are important to keep in mind, they have been either spent or actually inflated away. Because keep in mind that the real value of savings is what's important to households, not the nominal value. Then I think that the supply side shocks were a very important factor. And I think there's a strong argument, not to say that there should be no monetary policy response to a supply side shock, but it can be more moderate, because if you allow a supply side shock needs to play out through the economy. So if we think about it, oil prices go up, the cost for the manufacturing sector goes up, the cost goes up through the economy, inputs to services go up. So you get this kind of domino effect, which we very much see in the inflation numbers. And you need to let that play out at least to some extent, so that you avoid constraining the system too much and end up creating a welfare loss. And I think, this is really, I think, an important message at this point, that we had this debate with the team transitory and the team not transitory. When you have these type of supply side shocks, they can take a very long time to play out. So there is an argument for a little bit of patience. And I think what we can be comforted by right now is when we look at the price movements, there is certainly a strong argument in the data to say that the supply side shock certainly accounted for a good chunk of the movement. And we are seeing the inflation coming down. We are seeing moderation here. And so I think that's a good argument to say that we certainly don't need more insurance against inflation.
I mean, that there's a nice saying in economics: everything is transitory. In the end, it's just a question how long it lasts. But
that's like the other saying about just keeping your forecast stable. One day it will be right.
Someday it will be right, exactly. No, but so I think that's all. So we have the first round effects, as you said. There hits the energy price shock. 1 week later, you see it in the gas station. That goes pretty fast. But then from there, it goes to the producers, and fertilizers becoming more expensive and all the rest. And that takes some months or maybe even longer.
Yes.
And one of the points is to assess how long that would actually take, the first round effects. And then there is this famous second round effects, which is that may then even into wages and inflation expectations. Okay. So and you explained the first round one. On the second round effect, so inflation expectations, they've been very much concerned that those will be rising, and then we see wages rising. But in fact, wages have not increased as much as many would have initially anticipated, right? So we even thought that, they stayed below inflation. So what explains that?
So I think, this lends more weight to the fact that actually there was more of the supply side shock which was playing through here, rather than the concern of seeing some kind of wage price spiral emerging here, which was, the concern which is there. I think, unfortunately, in economics, it's rare that we're able to say, this is 100% this, it's 0% that. But I think there's a strong argument from what we've seen playing out in the data to date that there has been a dominant effect of supply side shocks, even though the demand side issues have been there as well. It's not to ignore them and say they weren't there. But I think what becomes super important now is just to look at the data. What is the evidence it tells us? And if it tells us that we're not seeing the wage price spiral, which we're not seeing the unanchoring of inflation expectations, which we're not, that we're seeing the various inflation components come down in the way that you would expect a relative price shock to play out in through the economy, as you rightly explained. In that case, I think the argument becomes, in terms of policy, where do we need to put the caution? So the ECB has explained to us that the September rate hike was extra insurance against inflation. But if you lean more towards the arguments that I personally lean towards, and I accept that we can have a debate here, in that case, I would actually argue maybe now is the time to take out a little bit of insurance against having too severe an economic downturn. Because if you look at the data for Europe, the PMIs tell us we're in contraction. The credit impulse data tells us that a substantial slowdown is coming. The confidence surveys, consumer confidence surveys, also tell us that people are quite concerned here. And, coming back to your point on the cost of living crisis, we should keep in mind that these excess savings we built up during the pandemic, they initially helped us mask the cost of living crisis because, of course, we had some extra buffer to deal with it. We no longer have that. And that's why, again, we have to be careful that wages don't go too high, but we also have to be careful that wages don't stay too low. It's Goldilocks on wages we're looking for.
Maybe we can go a bit back. I remember when Ukraine happened, and former managing director of the ESM, Klaus Regling, came immediately and said, look, people don't really understand that fully because they don't remember the oil price crisis. I do, and I know how this will play out, and this will be very hard because we may see quite some downturn in growth. Was he right? But I think there's a big point to that and to understand actually what happened with it. So, because with this energy price shock, we also see tremendously that money goes out of the country, right? So it's a transfer of wealth to those where we buy the energy. So it's a difficult situation. If you compare what we see today with what happened with the earlier during the earlier oil price crisis, are there any differences, or would you also make that parallel?
So I would start with the first important difference is that the way the central banks were set up back then was completely different from today. We didn't have the same, I'm doing a broad brush stroke here. We didn't have the same clarity on the central bank inflation targets. Mm-hmm. We didn't have the same operational frameworks in place. The way the labor markets behaved was very different as well. So I think when you add up a number of factors, you saw a very different situation. But the most important thing is that back then, we could really see that it was a stagflationary shock playing out. Unemployment went up, inflation went up. This time round, yes, inflation went up, but unemployment didn't go up. So this was not stagflation. It was not a stagflationary shock. It could have become, we could argue that it could have become, and we can, we're going to argue that counterfactual in the economic literature probably for years to come. But when we look at what actually happened, what we actually saw was that we saw that there was a very quick response to deal with the energy crisis, which importantly allowed the energy prices to come down. It felt slow at the time, but relatively quickly.
But I mean, I agree with you. So there are differences, which is monetary policy had a different starting position. You said labor markets, we can also say less energy dependency. Labor markets on wages, because at the time in the 70s, there was a lot of wage indexation, and we got rid of this in the meantime. But what you say, why then at the time we had a lot of unemployment and now we don't have that unemployment? What changed is this the key difference?
So, I mean, again, I think, we have to remember that we were still coming out of the pandemic as well. So we still had this pent-up demand coming. We still had those excess savings as well at that time. So I think, this was an important difference as well. So I think there are a lot of things that were different in the current configuration. But I think what to my mind, what becomes very different was, maybe if the energy price shock had persisted, maybe if the policy response had been very different, then yes, we could maybe have ended up in a different situation. But I think when I look at the structural differences of the economy today, as you rightly point to as well, when I look at the policy response that was put in place, I didn't see a reason for this to happen in terms of a stagflation shock. What I was more worried about at the time, and this goes back to President Lagarde and the 3 Ts, I was a little bit concerned that the fiscal policy response was failing to be targeted, tailored, and temporary. And so my concern was, rather than ending up in 1970s stagflation, was that we would end up with demand-driven inflation because you would get a new, potentially huge fiscal shock. And I think we did see a little flavor of that coming through. And now, of course, it's being unwound. But I was more concerned about that than the 1970s revival.
I think actually, maybe on labor markets, that's my view, but I think actually here's where Europe can take a bit of credit. I mean, for me, and that we already saw before, we even saw it during the sovereign debt crisis, is that actually labor market reforms in Europe paid off. We have gotten much more labor into the labor market, particularly female labor, so labor market participation is higher. And the drop of participation rates where people are in the market is much less during recent periods than it was in the 70s. And that obviously has also an impact then on how you look at wages and the wage pressure that emerges, because if people drop off and completely go out of the labor market, that increases wage pressure. And on top of that, obviously, during the pandemic, I think we also member states rightfully took a lot of measures, and the EU supported them in keeping people on the job instead of letting them go into unemployment. Some people have criticized it, but at the same time, this helped to actually be prepared for what you said happened afterwards, which was huge demand and people wanted to produce more. And if everyone would have been out of the labor market, the catastrophe, so to speak, or the constraints would have been much bigger. So I think actually on that one, Europe can take some credit for getting it right.
I think we did a fantastic job on the pandemic response. It was a completely new shock. It was a highly uncertain shock. And I think protecting people in their jobs was a very good thing. We saw the tremendous frictions that it caused in the US on the labor market. And I think that was counterproductive, to say the least. And I think another area where Europe did very well in the pandemic response was in terms of the tailoring of the fiscal policies, the support for the corporate sector. I think all of those measures were very well done. Where I'm perhaps a little bit more critical was the response to the energy crisis, where we saw less cohesion in the European response. Different member states did very different things, whereas the pandemic response was more cohesive. And especially, as you know, Rolf, I'm a big fan of Next Generation EU, although I would like to be operationally a bit more fluid. I think the overall program is the right idea. So we really saw the European solidarity. We saw a consistency of the response. We protected people in their jobs, and the fiscal policy was measured. In the US, the fiscal policy was oversized. People were not protected in their jobs. So I think from that respect, the US response was not as well tailored in Europe. My point was more on the war in Ukraine. I was a little bit worried that the European policy response to the energy crisis was not as consistent across member states, and perhaps not as tailored, targeted, and temporary as it should have been. So I think on the pandemic, full marks. On the energy crisis, I would say, not bad, but not as good.
I think this is, it's not only your view, but I think it has also been even documented. The European Commission has said it. And it's true, with the pandemic, so to speak, monetary and fiscal policy could go in the same direction and just give in, support the economy. That was what was required. Yes. When you have this kind of energy price shock, it goes in different directions. Monetary policy tightens and fiscal policy is inclined to step in. And so that is where the calibration becomes more different.
Absolutely.
And then it has been documented that the tailored, targeted, temporary, it effectively didn't happen the way it was meant to be. I think that is a fair point. But what I also find, it's kind of, you point to the differences with the US. So US fiscal reaction to the pandemic, just throwing money after many people, probably overdone, oversized,
yes.
And Europe more measured. During the energy price shock, not so much happening fiscally in the US, actually to the contrary. while Europe was giving in. But as a result, the US is still growing faster, it seems, and being stronger now. So, did we get it right or didn't we get it right?
So I think, if I put it quickly on the pandemic, I think we did a very good job. I think on the energy crisis, could have been a bit more, on the 3 Ts. I think the real challenge for Europe, I think on Next Generation EU, we got the concept right. But I think when we look at the US response with the Inflation Reduction Act, it's arguably much more flexible, much easier to roll out. And then keep in mind, it's unlimited until the US reaches its climate goals. So this is a very big difference from the European approach, even though I think there's a lot of merit and we understand the political differences. So what's holding Europe back today? Well, I think there are a number of things, but I think it's very, very important that we deliver on the European integration. There's always this sense that when we're not in a crisis, maybe it's not quite so urgent to advance on the banking union and complete this, which is still not completed. Not that urgent to advance on the capital markets union, not that urgent to think about some kind of fiscal tools that we probably need to move ahead, not that urgent on our energy union either. So we tend not to move as quickly as we need to, even though in crisis, at least so far, we've done very well. And I think this lack of urgency is an issue. And I think this is where we really need to make a huge effort in terms of driving a very strong growth model for Europe. And we have the potential to do it, but we need to move on this.
I mean, another saying that comes out of political economy is never waste a good crisis, so to speak, for making progress on reforms. But I mean, we are in a crisis mechanism, and I prefer not to having a crisis in order to make progress.
I think this is the point,
and eventually, we also acknowledge that Europe has made progress and there's more resilience. Let us talk about the long-term implications later a bit. I would still like to come back to what you said before on households, right? So on everyone's cost of living, on the savings, what does it actually mean? So we have had this energy price crisis and now inflation is going down, but the price level stays high, isn't it? So people are still squeezed, and how do they react?
So, at the end of the day, I think we see it very clearly in the economic data. You end up with an economic downturn because people are losing purchasing power. What you also see is corporate margins are also coming under pressure now. We are beginning to see the bankruptcy rates normalize. We are beginning to see labor markets becoming softer. I do expect to see higher unemployment over the coming months, which means we are heading into an economic downturn now. Fiscal policy is tighter. And I think what becomes critical now is that we actually do get some monetary easing, because it's all about the balance of ensuring which risks should we insure. Should we have extra insurance against higher inflation, or should we think about taking out a little bit of insurance against a weaker economic outlook? And when I look at the data, inflation is coming down, as we could expect it to, if we are in a supply side shock dominated world. If we look at what's happening on the household balance sheets, on the dynamics, on the corporate balance sheets, credit impulse, I think there's every argument to start thinking about monetary easing and maybe thinking about it a little bit earlier than having to wait for inflation data coming out in April.
Well, that is then on the current monetary policy setting. We will see how that unfolds. But so I think from what you said, indeed, and households have lost in terms of real income. And I mean, we have also done some work where it shows that particularly the poorer households have lost relatively more because they have to consume more of their income than the high wealth people who can save more. So they are more affected. And that is certainly also justifies political measures, fiscal measures for helping those households, and the temporary targeted measures were well taken in that regard. So I think that is good to acknowledge. At the same time, I also understand, if you look at it, with inflation coming down and we have still some wage growth in the pipeline, that means that real wages will be catching up again. So relative to inflation, people will recover some of the income, and that's good.
Which is a very good thing. And even with my somewhat lackluster growth outlook for the euro area in 2024, real wage growth is absolutely key to securing that forecast. And what we want to see now is we do want to see the balance between profit and wages swing back. So we get back to more normal levels. That would be the right thing to happen. Again, it's a question about the speed of adjustment. And if wages go up too quickly, that's where we know we can get back into these stagflationary tendencies, because then I think the flip side of that would be that companies would respond much more aggressively in adjusting labor. It's always very hard to measure, but there are some arguments to be made, and you can see it in the PMI data as well, that there may be some labor hoarding going on right now in Europe, which is also a warning that companies, if pressured toughly, would shed labor quite quickly. And I think this is what we want to avoid, especially in a situation where some of that labor shedding is going to be mechanical just from the bankruptcy rates going up. It's something we're already seeing in several of the member states, including Germany. So I think we just need to, it's a balancing act, which is an important one.
In a way, I share some concern about companies, but before that, I think still also good to have clear where, looking at labor markets first, I think that unions have been very responsible in their wage reaction. So by taking this initial hit on income, actually they allowed for some kind of workout of the shock that has hit the economy.
Absolutely.
And now increasing real wages is also okay, quote unquote, in the sense that some of it is helped by productivity growth. And then it's not kind of pressuring, putting more price pressure. So that there was a very responsible reaction in that regard. And it's also understandable, as you said, if your savings are worth less in real terms, you really want to recover on that. And this against the backdrop of a tight labor market. So I think in that regard, and we don't see that wage price spiral that many had thought would happen. So I think overall that is still looks relatively well behaved. If I think about companies, it's very interesting because during that kind of cost of living crisis discussion, there was also discussion on profits. And actually there was the wording of greedflation was created, which would kind of contradict this, or the companies are suffering. So who was actually suffering in that regard, right? So, were companies faring so well? Some got good profits. We know the results.
No, absolutely. We have seen a number of companies who enjoy good profits. My point is, and again, when we look at the wage profit split, it would be absolutely fair now to see some adjustment of that going the other way. And that's very much part of my forecast, and I expect that to happen. But like any adjustment, if it's happening too quickly, I think the way it will work out will be unfavorable, and especially to the lowest income households who will be hard hit when unemployment goes up. So my point is just to say we need to be measured in how we manage this adjustment. My point is not to say that profits should go up as a share of GDP forever. That makes absolutely no sense, and it would be dangerous from an economic point of view. So that you have a renormalization of the wage profit split. I think this is normal, and I think when we look at forecasts from many institutions, including the ECB, this is what many economists have built into their forecasts. And inflation is coming down. That will help the dynamic, but as you rightly point out, it'll take some time for purchasing power to come back. So that will take time. But I think some patience is a good idea to have, because if you put excessive negative pressure on the corporate profits, they will respond much more aggressively in terms of the labor market situation. So yes, we did see some corporates that had very good profits here. But we always have to remember, when we have an exceptional profit cycle, we also had periods where profits were very weak and threatened. So, we need to look at profits over the cycle. And that's why I emphasize this dynamic of looking at the wage profit split within GDP rather than just focusing on the relative growth numbers. It's really this split that I think is key to watch.
I think, from what you say, on my side, two reflections. One point that you also make in the report is sectors matter a lot.
Absolutely.
And so I actually also think that some sectors profited and had big gains, others didn't. And there was quite a variation across those sectors. And we know that they're high energy intensive sectors, they were incurring losses. This is actually what we see. And from that perspective, that is one aspect. The other aspect is, I also think, as you said, is exceptional in the sense that you had this big shock, unprecedented. Everyone was under pressure. People can very much understand that companies need to adjust prices, and that is what they did. So everyone is in a way in the same boat. But if we move into a situation where now the economy is slowing down, companies are affected differently, this kind of common pressure may not be there anymore to the same extent. And then companies need to adjust again. And so price setting should change.
And I think we're seeing that in the inflation data. I think we are seeing the price setting changing. We also see it when we look in the survey data for the selling price expectations. And what's interesting is, this idea of, as you rightly say, first you have the companies that are hit hardest from the energy shock. They try and respond first to the price shock, and then it dominoes through the system. And we see that the service sector, it tends to be the slowest to respond on the up, and also tends to be the slowest going down. This is exactly what we see both in the survey data and in the price data. So this is very much playing out as we expect. But I think, one of the important things to consider here is that we've been through these exceptional supply side shocks, but as we look ahead with climate change, with concerns about biodiversity, these shocks that we know are coming, the risk, and we see it also now, we have very sadly a new conflict with Israel and Hamas. And so what we see now is we're seeing some new tensions which are coming from the issues around the Suez Canal, with tensions on the Shanghai Freight Index is a good way to look at this. So we see these various aspects, the risk of new conflicts, the risk of climate change bringing disruptions, the risk of biodiversity loss bringing disruptions. So I think we are in a world now where we are going to see more frequent supply side shocks. So thinking about how these relative price shocks that result, how we should respond to them, is I think an area which no doubt deserves a lot more work. But I think it's an area that we really need to think hard about, because what it means to my mind is we are likely entering a world which much shorter and more volatile cycles. And this is completely different to the period that I've known in much of my adult life, where we basically came, so I'll show my age now, but I think it's visible, where we came from the 1980s and we had this great moderation of the economic cycle, which really continued well into the 90s and pretty much up to the great financial crisis. It was also a period towards the end, especially, of very low policy uncertainty, with very super long cycles with fairly shallow recessions. And I think now we need to prepare for how do we deal with these more volatile supply side shocks, which is going to be a real challenge.
In the short run, and that receives now a lot of attention. So what are the inflationary pressures now? And you mentioned the armed conflict, and you mentioned the increase of costs in transport. And yes, there are reports on the Suez Canal. But is that in any case comparable to what we saw in the pandemic, or are we still far away? Or
thankfully not. Yeah, no, thankfully not. The shocks that we're seeing so far pale by comparison to the pandemic. So this is a good thing. But my point is just to say that this succession of supply shocks, some may be more moderate from an economic point of view, some may be more significant. But I think, when we read the literature on climate change, and then also, you made a very important point, Rolf, when you talked about the differences between sectors. When we think of the climate transition, it's also a big sectorial shift that we're facing.
Mm.
When we think about physical climate shocks, they will impact different geographies differently and likely have very different sectorial impacts as well. So we can see a lot of risk coming from, I think, these relative price shocks in the future.
There are different fears out there with a view to climate change and inflation, right? So the one is that, yes, we have different energy markets. And we are now, for example, for gas, Europe is more, and Germany in particular, is more dependent on international markets, liquid gas as compared to stably priced Russian gas.
Yes.
So that price volatility is higher. That's one thing. What plays into that is also the question of prices or volatility of renewables and how we can level that off within Europe. But the other fear is that inflation will be higher because we may be having not enough energy in the transition, or relative prices of renewable energy may be higher. So where do you land with this in terms of expectations on also inflation levels will be up in the future?
So I'm less worried about the absolute level of inflation being higher through the cycle. My concern is the volatility. My concern is the volatility because and I think we can argue the inflation story from both sides. Absolutely true. I do think we see, many good arguments for why we could get higher inflation from the climate transition, from physical climate risks. But there are also some factors that could be disinflationary, depending on how we change our spending patterns. There's a good argument, and at a very personal level, I think my husband is looking forward to this, that we should have smaller wardrobes, I think he thinks it's a good thing if I downsize my wardrobe, and he's no doubt right. So I think, the way we spend, the way we behave is also going to change in a big way. We shouldn't really forget that here in Europe, a big part of the adjustment to the energy price shock was also a change in behaviors. Many of us have turned down the temperatures. Many offices now have clear policies, both for summer and winter, 19 to 26 degrees. It's numbers that we're all very familiar with here in Europe. So we see these changes, and I think many of those will be permanent. We saw a lot of companies thinking about, how can I optimize my production, especially now that the energy prices are higher. So we've seen a lot of behavioral shifts. And I think that's going to be a very, very important part. But most importantly, I also think when we look at the service sector, I think the same or similar type of process that we saw on goods in the past could reproduce. What have we seen in goods over the past decades? We've seen that robots moved into the factories, so automation in a very big way, and we saw globalization. What do we see in services right now? We see, there's a lot of excitement about AI, all of this digitalization. Some of it's new, some of it's not so new, but we see a tremendous shift in the service sector. Plus, we also see relocation of services. Now, with teleworking, maybe you can hire someone who lives a little bit further away. So, you see there's tremendous shifts. Will they be inflationary? Will they be deflationary? Hard to know. Debt reduction, that's certainly disinflationary or deflationary. We see that in China right now. China is going through a tremendous debt reduction. Will Chinese electrical vehicles have a disinflationary force in Europe or not? We'll see how that works out. But I think when I'm listing many, many things, but my point is just to say you can find arguments on both sides in a big way. But what I think it comes down to is that there's a strong case for much more volatility here.
No, that's true, and I agree with you also with the view on the arguments on both sides. I mean, the big policy challenge is to get the transition right for climate change in order to have this energy security and also avoid tremendous inflationary pressure. So you need to get energy supply right in order to be able to stabilize prices efficiently. And then in the long run, there's actually pretty much good chances that gains kick in, and actually we have enough energy supply, and then it's all fine. But it's a tricky balance. The other point that you made is with a view to labor markets, and here, I mean, you basically said, well, there's this book by Charles Goodhart, among others, on the aging and the impact that we are getting towards a world of scarcity of labor. We have had before what you described as a long cycle was basically a cycle where increasingly we got female labor, emerging markets, others into the labor market. Now we have done that. The next decades will be that labor is tight, and that is why wages will be higher, and that will lead to inflation. You're saying not necessarily, because you believe more that artificial intelligence and other things will help us out of that.
Well, the other thing is, I mean, I think when you look at the labor supply side, first of all, and we see this in Europe, pension ages are not the same across Europe, but we do see more and more reforms where people are working longer. Many people actually like to work longer as well, so we see this as well. I think, one of the absolutely critical things for the transition, but I also think for social mobility from many aspects, is education, both primary and secondary education, but also lifelong learning, because many of us will have to switch jobs in the future, switch sectors. So I think it's very important to have this educational aspects. And so when I look ahead, will we be facing tremendous labor shortages? There's a risk, but not necessarily. I'm not necessarily sure that will be the case. So potentially, yes. And I just think that there's a lot of potential when you look inside of Europe today, especially for older populations, many of whom would like to participate longer in labor markets. So I'm not necessarily saying the pension age should go up for everyone, and we need to consider what type of jobs people have had and how long they've been working for. So I think there are many parameters that play in. But for people who would like to stay in the labor market and add value, I think there's a strong case to be made.
We see that actually, indeed, that pension age is increasing along with, and in some cases, qua law in line with life expectancy, and we see how that works. And the third factor is deglobalization or fragmentation, right? So where more trade barriers means less supply of goods, higher prices, relatively higher prices that have to be absorbed, which forward-looking can be another source of, or may remain a source of volatility, may remain a source even of inflation. We will have to see how that plays out.
But I think what's interesting just on that final point is we don't today see a huge movement back inside of national borders. We are seeing considerations in how supply chains should be organized. We are moving away from the just-in-time to the just-in-case world. We are seeing more geopolitical considerations moving into supply chains. But at the same time, companies are still present around the world. They're still present producing locally. And so I think the idea that, this is it, it's globalization in reverse, I'm not sure that's entirely the case. What I do see is a risk that we become a more regionally fragmented world. That's certainly a risk out there. But I think, again, with all of the dynamics on the service side, I think that's something to consider as well.
I mean, we are to maybe wrap this up a bit, but I have, so to speak, the $1 trillion question, euro question for you. No, for me, the point is the following. We have talked a lot about those long-term factors. You have explained why you think there is an impact on volatility. The other part that kind of frightens people a bit is the question, indeed, I mean, we have gone through this episode of very low interest rates, and you think that interest rates should be lowered, but the question is by how much? And people also think, I mean, people are also worried about interest rates staying higher and therefore mortgages being more expensive. So where do you see the long-term interest rate going in real terms relative to inflation? So will we be living in a world where saving is more expensive, or how do we have to look at the long-term future?
So, as I look ahead, I think that an equilibrium interest rate in the euro area of around 0.5 to 1% on the short-term the neutral interest rate, what we like to call the R star, seems to be a fair guess today. But I think there's going to be a lot of debate around that level. We've already seen a lot of debate coming through. But I think the most important thing that we need to think about here is how to ensure that, we talked about potential labor constraints, we talked about potential constraints from the energy system, and all of this argues for investment. And this takes us back to perhaps something we haven't talked that much about right now, is how should we finance all this investment? If we do it through purely public investment channels, the IMF had a very nice study on how public debt can actually just explode from this, which is not a good situation. So I think the most important thing for us to think about here is, how do we alleviate the supply side pressures? Well, thinking about how we foster investment is key. How we foster labor supply is key. And I think that's really the important thing in helping us to keep a more balanced interest rate environment. What I do think is, I think we need to be careful not to be over-reliant on monetary policy. And if I look back to the pre-pandemic era, I do think we had become overly reliant on monetary policy. I'm not sure negative interest rates were a positive thing. I actually think they were a negative thing. So I think that's an experiment we don't have to repeat. So I think we need to create an environment where we can foster the investment growth. And it's not just about financing, but regulation, many, many things. But I also think we need to be careful not to believe that monetary policy can fix everything.
You're from a big bank.
I'm from a big bank.
But then and you said we need to look into financing and how we finance investment.
Yes.
And then there are different concepts out there and different proposals how we can best do that. And some people say we need banking union, and because we need to make the banks work better in Europe. And other people say we need capital market union because we need other financing than bank financing. You are in a bank. How do you look at this?
So now you're going to think I'm incredibly greedy, because I would like both. And it's very interesting, because when you look at the US model, which I don't think is a model for everything, I just want to emphasize that. But if Capital Markets Union in the US works with large US banks. I think for capital markets in Europe to work well, they need to work with large, genuine European banks. And so this is, a very strong conviction. I've even written a paper about this. So it's, a written conviction as well. And I think the two go hand in hand. If you look at how the capital markets operate in the US, if you take out the banks, it doesn't work anymore. So I think it's a hand-in-hand process, and the two come together. But I think both for the retail consumers, having genuine European banks, having a genuine banking union would be a huge win for the retail side. Having capital markets union, I think it's a huge win. And one of the interesting things that we often overlook in this debate is the role of the public sector. In the US, we have a single treasury market. In the US, we have government-sponsored enterprises that play a huge role in mortgage markets. We have the Small Business Administration, which is very supportive for the small business enterprises. And I think this is one of the lessons from the European debt crisis, is when you do cross-border private risk sharing without having a role for public risk sharing, well, private risk sharing tends to pull back in moments of crisis. And we see this in the US data as well. There's excellent work that's done on this. And so I think when we think about the design of our banking union, of our capital markets union, it's very important that we also think about the role that should be played by public risk sharing and underpinning private risk sharing, so the two can work together in a good fashion. And that's not to say that we shouldn't have private risks. It's not about creating moral hazard, but it's about preventing crisis. And here I think what we did in Europe after the last crisis was a very good step in the right direction. And we need to think about more public risk sharing. We need to think about more private risk sharing.
On that one, we certainly agree. And just we are at the ESM. The ESM is the entity of public risk sharing.
Absolutely.
We did our share in actually preventing the euro area from falling apart, essentially, and making sure that risk sharing works, that people have more certainty. And as you said, in that way also allow for private risk sharing, because otherwise investors withdraw, savers withdraw. I also agree with you that in Europe, it's very hard to think of financial markets working, banking, capital, without the banks having some role in that. There needs to be cooperation on that side. And we need to have it in order to have enough financing for growth in the future. Michala, has been a great pleasure talking to you.
Thank you.
And we covered a lot of ground in this lunch talk, where we have talked about inflation, the exceptional state of the crisis, the resilience we had in Europe, but also the challenges, among others, the challenges in the long run. And we will return to you.